Okay, welcome everyone. Let's we'll start our lesson 4. Today lesson will go through LO4. As you know me, my name is Anjum Sata. Please, if you have any question, drop me email anjum@ukversity.co.uk and I'll try my best to get back to you as soon as possible. Today lesson will be able to interpret the financial statement and make recommendation. That will be the key, the question, how we can measure the performance of the company, how we can interpret the financial statement and financial statement used by various, the stakeholders. So during our previous lesson, we learn about accounting statement, statement of comprehensive income, statement of financial position, statement of cash flow, and statement of chain in equity. And we prepare under IS1. We discuss inventory under IS2, net realizable value and inventory need to be recorded, lower the cost or net realizable value, whichever is the lower. We discuss about IS7, which is cash flow statement. We discuss about IS10, events and adjusting event. We discuss IS16, property plant equipment. We discuss about IS19 and IS36, impairment. And we discuss about 37, goodwill. We discuss about 38, and these, the goodwill revaluation, impairment, and all, the different under accounting standard we discussed. IFRS 3, we discuss about business combination. We discuss about consolidated financial statement. We prepare a parent, subsidiary, and associate. We said if you own the share of other company 52 or more than 50%, that's known as a subsidiary. 20 to 49% is your associate, and less than 20% is simple investment. We went through the stakeholders, what is meant by stake mean interest. We discuss about qualitative characteristic, year-end adjustment, depreciation. All we went through in the previous lesson, and we discuss about also PPCIO, popular people chat in offices, and that's which we went through the professional code of ethics in the previous lesson as well. Okay, so today will be key focus about financial statement, consolidated or normal, and their interpretation, which we'll go through. Okay, so today we'll look around the various financial ratios. We'll discuss, and how we can prepare, how we can report, and we'll go through micro companies and we discuss about, the various reporting standard. Okay, so 4.1, interpret the financial statement using financial ratios. So when interpreting the financial statement, important ascertain who are the user account and what sort of information they're looking for. So financial statement need to be true and fair information, and they can make the various decision, and it can be, there are various users of the financial statement. Those use financial statement to make the decisions, that is quite crucial. Anyone, any question here, please? Okay, so we look, the financial ratios, and the formula sheets is available on our Moodle page. Extra revision cards, the Kaplan is available on our Moodle page, so please, follow those as well. Ratios are the simple calculations based on the interactions in the set of the data we can collect, the major financial statement, like the statement of financial position, statement of comprehensive income, or we call profit and loss. So we can look around the chain is the last year, 2 years. As a qualitative characteristic, we need a comparative figures at 2 years. We can look around what's happened. So you have to interpret is through, and it can be various interpretation according to their what sort of decision they want to make, the user of the financial statement. Okay, guys, let's look, the ratios. We can categorize into 4 major categories of financial ratios, which we prepare in accounts. So what those are 4 types of financial ratios we calculate and interpret in, and those are quite crucial, in the financial world, which we need to be. So we have the liquidity ratio. Liquid mean anyone who has any interest in the business is called liquid ratio. That's quite crucial, which we need to be look around. And then we have to look around the financial position, we need to be look around the profitability, and we look around the use of resources. So these are very important ratios which we need to be interpret in term of that is quite crucial, which we need to be look around. Any question, please, if you have? So liquidity ratio is liquid mean anyone who has any interest in the business and in the current asset can divide it by the current liability. Liquid mean anything which we can convert into the cash or cash itself. The quick ratio normally is not looking. So that's quite crucial, which we need to be look around. That's quite, in term of, the interpretation of the ratios. So, so please, when you look, the prior liquid, so near to cash or cash itself. Profitability ratios, which we'll go through in a minute. Financial position ratio, also known as the gearing ratios and interest cover ratios under these ratios. And we'll go through the use of resources, also known as efficiency ratio. Okay, so as all these formulas please given, the gross profit margin quite useful to use. Net profit margin, return on capital employed, expense percentage to the sales, which help to measure, how we can, how many percent expenses, and the inventory turnover, trade payable, trade receivable turnover, working capital cycle. These are very important ratios to calculate, how efficient we are using these sources. Okay, main thing, that whichever ratios we calculate is interpretation, look around your objective and the financial statement, look around true and fair information in the light of, and we can make various decisions. Okay, so we can calculate, always good to be calculate 2 years ratios, always good to be compared with the same size of the business and their competitors, and look around the perspective which we calculated. Not only relies on the ratios, maybe before COVID-19 ratio were appropriate, but what happened after COVID-19 lockdown and all. So we have to look around the political, economic, social, and technological environment. So return on capital employed, it shows the profit from operation divided by total equity plus non-current liability. Why non-current liability? Because it's a long-term liability. We borrow money for major and investment purposes. That's the reason we do, and we want to look around what is the return we have here, the capital we invested. So profit from operation, total equity plus non-current liability, profit from operation divided by revenue times by revenue, total asset minus current liability. These are different formulas. End of the day, your objective, what really you want to achieve. Retire profit for after tax divided by equity. So if you borrowing money from debt or equity, you're looking which one is the best. Debt normally is cheaper than equity because equity you pay the dividend after the tax. That's why we calculating this ratio profit after tax. May the return of ordinary shareholders and the investment return of equity excluding the debt financing. Okay, so profit from operation divided by revenue, we can look at our operating profit percentage. Gross profit is measured the overall profitability of the business. Okay, we can look around. It's quite good to be used, like administration expense, electric expense, energy expense. How much is the percentage of the revenue going towards them? So we try to be look around. Can I reduce it? What's happened the previous year, this year? If activity increase, the expenses increase accordingly. It's been and how well we manage them. So that's also we need to be look around, and that's quite crucial, which we need to be explored. Okay, then please we look the liquidity ratio. What is meant by liquid? Liquid mean anything which we can convert into the UK itself. So that's we need current asset divided by current liabilities. We can quick ratios, current asset minus inventory divided by current liability. That's also quite crucial, which we can look around. Okay, so working capital ratios also is quite crucial. We need to be look around inventory turnover, cost of the sale divided by the inventory times, or we can look around inventory divided by cost of sale times by 365. Why 365? Normally operation in a year is 356 days. off, and we can look around how much is the holding inventory days, because the inventory holding days should be lesser. So that's, so the cash flow will increase and the company performance will be better. Okay, then we can look around trade receivables and again the revenue, how many days we receiving money. Always receivable days should be quicker and the payable days normally should be longer according to the industry benchmark. Always look, and the working capital cycle, inventory turnover days plus receivable minus payable, that indicates, that's quite crucial, which we need to be look around. Any question from anyone? Yes or no? Please, if any question you can ask. Okay, so guys, next we pick, two companies from their financial statement. We pick these figures and we calculate, under four categories. You can pick few ratios so you can compare the performance. So gross profit margin divided by revenue or sales, or we call it turnover, time by 100. So we 45% in Ika's turnover compared to Paprika. These are two companies, close competitors, and Paprika's performance is a better when we look, gross profit, because the sales can be credit sales as well. Like, a lot of companies, some company may be using the creative accounting that, so we have to be not only relies on the ratios, we look the other elements as well. Okay, operating profit, we can look around operating profit divided by revenue time by 100, so we can 9% in 11, so Paprika is better. When we look the gearing ratio, debt divided by equity, or debt plus equity divided time by 100, so that's, please, that ratio is also crucial. So if we look the Nika is 13% risk, this indicate the ratio, the risk, risk measure, and this is 71% alternative debt, because the Pipika has the high debt company. No doubt they have the sale more, but the sales can be up to some extent. Never know. It's linked to the cash sale or the credit sale, which we need to be further interpret, by looking. Interest cover ratio, the profit we have, how many time again the finance got the money we borrow, is covered 11.6 time and 3 point. So in and asset test, which is liquid ratios, current asset minus inventory. Inventory, like if you have a window 98 CDs in your warehouse, because window 98 CD is not appropriate for, because it's outdated. Inventory should be recorded at cost or net realizable value. So we have to look around these. That's why we take out inventories. So look around the most liquid asset 1.22 of 0.65. Okay. A company performance may be compared its previous period performance, past result may be adjusted for affects, the price changes, and this is the referred to as the trend or the vertical analysis. The weaknesses for this type of the comparison, there is a no independent benchmark that can be, and whether the chosen company current year result is good or the bad, so we have to look around at 2 years and with the same company and within its competitor. The problem of vertical, it's a common compare company performance for the particular period performance equivalent to the same period and introduce independent yardstick of comparison. It's similar. So you have to look around the type of the analysis, which further we can look around. So when you analyzing the industry average is very, very important. Are we performing better than the industry? Are we performing worse than the industry? That's also quite good to be look around the performance when you're comparing with the company. Okay, so the ratios, we can look around its impact on the decision making of these ratios. Look around the certain weaknesses of, and then you make the decision, like trade payable, trade receivable days, and then inventory turnover days. So that's why the JIT, just in time inventory method, which is most of the company prefer to do, because they help. Okay, these are the key users of the financial statement. Investor, they help to determine whether to buy or hold the shares by looking the performance interpretation of the ratios. And future investor, the lenders and the supplier, they want to either give the credit for looking the trade payable and trade receivable days, the customer and the government who they want to collect, look around the taxes they've been paid in terms of the turnover, how much percentage of the taxes being paid. So that's very crucial, which we need to be look around in the light of these, the ratios. Okay, gross profit is a better in Paprika if we look at these two companies, and Paprika's operating profit better. When we look the gearing ratios of Anika is better, Anika's interest cover ratio, asset test ratio. So in the light of these, all these ratios, because the Paprika is a high risky, and when we look the return is only 2% different, but when we look the risk, so you're taking very high risk and only the 2%. So we in the decide, we decided it's better to be go for a Nika instead of a PKR to investment. So our decision will be, so you can, based on this various ratios you can, but look around the purpose what you want to be. Okay, guys. Then of course when we move to, we can look around the next element. Okay, so some extra reading, please, and I included the link for you. Then we look, the 4.2. Are we look the in the merit criteria for this, please? So we need to be look around the financial statement, and interpretation of the financial statement is very crucial. We have to do creative accounting, because we can rely on these financial ratios, but some other decision we can make wrong. So we have to look around the manipulation is happening. Sometime inventory evaluation method under IS2, which is maybe you can using the first in first out or FCO, and then you chain those. That can be your closing inventory values can be different, or your sale value can be changed, because that's also is the creative accountant carry on manipulating things. So we have to be look around. So these are the biggest scandal of creative accounting which has happened in the world. So that the facts and figures be manipulated, the financial statement sometimes not give the true and fair information. That's why we have a new standard carry on coming, and we have ethical morally responsibility to give the true and fair information. So we have the biggest company 3 hour movies, guys, on Enron, which is quite good to explore Enron scandal, how Enron changed and impact the facts and figures on and leads to. So please, that's also quite crucial, which we need to be look around in the light of. Okay, then please we look the world telecom and scandal that we need to be look around. That's happen, in term of also manipulate the creative accounting. American American insurance company, which is a group scandal. That's also is welcome. Nishi, okay, thanks for joining. Okay, so we can look around the American insurance company, which is creative accounting. That's they use a lot. So we have to look around Lehman Brothers is the creative accounting scandals as well. Definition: the process account use the knowledge and accounting rule to manipulate the figures. That is the creative accounting. Transforming of the financial accounting figures and changing according to their own perspective to. But we have IS1 International Accounting Standard 1, which says, a financial statement need to be true and fair. So if the financial statement not represent true and fair information, that can be misled, and we shouldn't be. That's why we have a IFRS 16, which is International Accounting IFRS 16, which is International Financial Accounting Standard 16, about the leases, because in the past, the finance lease and operating lease, the finance lease we used to be treat as asset in the book of account, and we used to create a liability against it. But the operating lease we not used to, whatever the rent we used to make the payment, and we'll carry on making the payment, or we used to be creative not outstanding. But now they're saying, but we not used to reflect how long commitment we have in the operating lease. But now you have to treat as asset, you have to create the liability credit, you have to look around the current liability, which in 12 months you have to, so you have to carry on appropriate, you have to look around the present value of the asset, again the future cash flow. These are the quite crucial which we have to look around in the light of these. So that's why it's very crucial in creative accounting. We should follow in the law and the new standards carry on coming. Creative accounting hide the particular bad years of the company. They force an exceptional good years, continuous pressure, always best, smooth result and boost assets. And they can delay the payments and to look at the figures nice, that can be how the accountant regulate creative, reduce the scope of the choice of accounting method, minimum use of the judgment, and invoke, the concept of substance over, and those we need to be looking at. The reason of the creative accounting, the report steady growth, profit, avoid, rising expectation of high good years, and many conceal, so we shouldn't be look at the financial statement manipulating profit in the forecast and keep income boosting and making contract dummy sales figures in the book of account. That's because sale is can giving to the credit to the company, your relationship with that company, and then you putting back fake invoices in and looking your sales good ultimately, and then after the reporting you change the figures again because the sale return. So these are all the creative techniques used. Some of the common method of accounting manipulation: excessive provisions can be extraordinary item not allowed anymore, and off the balance sheet finances, which is capitalized, the cost, non-trading profit, brand accounting, and various others we can look around. There are the legitimate techniques can be employed in computing certain accounts, like you're looking the inventory evaluation method to look your but is the ethics unethical, because if the comparative figures, if you're changing any inventory evaluation method, you have to reinstate the previous figures, because end of the day you want to be true and fair information. Thus, we have still issues. These are conclusion. The creative accounting should be used if is within the justification of the law and achieve the company ultimately goal. Increasing the star must be the benefit to the company in the short run, but in the long run not to be mislead the financial statement and provide. So please, I included the link for further reading if you want. The question on the financial ratios, we discuss four types of financial ratios, and we use ratios to interpret the figures in the light of and that help to make the decision, and the decision making selecting the best course of action. Trade receivable, so we discuss four types of financial ratios: profitability, liquidity, use of resources. Those are quite crucial, which we have to look around. And that's we need to be carry on. So please, we can look around the question which is given Osborne handout on our Moodle page, so that can be used to look around. The formula sheet is available. It's a matter of picking the figures and calculating the ratios. It's better to be calculate 2 years. Look around the last year, this year, what's happened. Look around the purpose why you interpret, why you calculating these ratios, and various stakeholders use these ratios to interpret the information and decide themselves, which area the company is performing better, or HMRC looking the tax being paid appropriate, suppliers looking the money is paying on time or not, tradable, trade receivable and trade payable days, inventory turnover days. These are also, yes, the lenders also looking these ratios to lend the more uh, to the companies or not. So please, you can calculate these ratios as in the light of liquidity ratios. Liquid mean anything which is current asset divided by current liability, profitability, gross profit, operating profit, return on capital employed. These are very important. The use of resources or efficiency ratio, trade payable, trade receivable, inventory turnover, working capital cycles are very important ratios. Gearing, debt divided by equity ratios, which is high gear, high risk. Interest cover ratios, that's also quite good, which we can look around in these, the financial position ratio. That's all from my end. Any question, Hani? If you have, please, if you want to ask, Uh, so next lesson we'll do assignment discussion. We will be back and we'll do recap of all lessons, whatever we cover until now. those 4 learning outcome and how we can address within our assignment brief, accordingly, and met, all the learning outcome, and where we can pick the examples and we can embed in our assignment. That will be in our next lesson. And so please, make sure you will attend the next lesson. That is quite crucial because we can recap everything, whatever we learn, or if you miss, anything. Any question, please?
Hello.
Okay. Hello.
Yeah, good afternoon.
Good afternoon. You okay? How are you keeping?
I'm fine, thank you. Yeah, I'm so sorry that I joined the class late. I just want to ask a question because there's no way I can speak to you verbally. Yeah, I've submitted my work.
Okay.
Yeah, I've got a pass, but is it okay for me to resubmit?
I'm not
or
sure.
that's the final grade?
I'm not sure if not being IQ is internally moderated and quality and not being submitted to external awarding body, then it's fine. You can request, yes. If you send emails to learner work, yes, you can let them know you would like to improve it for higher grades. Yes, you can, and they can look around if they're not being signed off. If the unit being signed off, it means they closed it.
Okay. So what's the way forward now? Has it been signed off as a pass?
Yes, because if the pass, if
Okay.
we already informed whole batch to IFA, yes, and IFA Direct, the qualification awardee ATHE, then it's been signed off. So we can't really go back to amend the grade. Huh?
Yeah, I'm not too sure because you said in the grade that if I want to resubmit, this is what I have to do. So
okay.
Is that fine now? I'm not sure. It's not clear.
Okay, so what you can do, if you drop emails to learner work, yes, at ukversity.co.uk, so tomorrow morning someone reply you, yes, and if it's still within our control, so you can resubmit it, yeah.
Okay.
And we can remark it, yeah.
Okay, no worries. So what's the deadline? Okay, if it's within your control. So I have to email the learner's email address.
Yes, if you send them email, say, I got grade pass, but I really want to either merit or distinction, I would like to resubmit it. So please let me know. If not being signed up, it's still in the case, I can resubmit it. If they say, yes, you can resubmit it, then it's fine. You can resubmit it and we can hold the result and we can add in it to next batch.
Okay, no worries. So I'm going to email them tomorrow and see what they say.
Yes. If it's already been signed off and the badge been sent to, then it's difficult. If not, then it's no problem.
Okay, all right then. Thank you very much.
Very welcome.
All right then. Thank you. Bye.
Thank you. Bye-bye.
Bye.
Yes, please, if any other question you like to ask, so we can go through. Otherwise, we'll keep up to here and we'll go through next lesson, our assignment discussion. And please try to join and we'll go through all the learning outcome and we'll do recap and we'll go through how we can address all the learning outcome within our assignment. That will be the key. And thanks for attending. Have a lovely weekend.